Hello there everyone. In today's video we're going to be focusing our attentions to loss aversion. Now loss aversion, one of the more common ones, but such a nightmare. So in this video we're going to be talking about just how much of a nightmare loss aversion can be, what loss aversion is in the first place, and most importantly, how to minimize the risk of loss aversion taking an effect on your trading performance. It's a great video plan guys, so let's get into it.
So what is loss aversion?
Now, loss aversion in a nutshell is the idea that new retail traders much prefer avoiding losses than obtaining gains. It's that feeling you get from losing a trade. It's so bad, it far outweighs the joy you get from winning a trade. And so that is loss aversion. Okay, that's really interesting. So how about we go and actually find some real live examples happening in the charts? There's no better way than to actually visualize exactly what this loss aversion looks like, right? Because by doing so, hopefully you'll be able to avoid it in the future. So let's get to it.
Hey there guys, so let's have a look at how loss aversion essentially looks in the markets. So we've got a chart in front of us here. As we can see, we've been making some nice consistent impulsive correctives all the way down here. We've got lower lows being formed, we've got lower highs, clearly in a bearish trend. So what we're going to be doing here is we're going to be looking for a price action pullback to enter into the market. Now I don't want you to think too much about the technicals here, but for the sake of this example, we're looking for an area the price can pull back to. So we've got the beginning of a nice price action pullback here. I'm going to draw a nice little anchor point right the way across. Again, don't really focus too much on the terminology and stuff yet. This is your first time viewing myself and you won't have any idea what I'm going on about here. But essentially we're looking for pullback entry into a bear market. We get the price action pullback. Fantastic. We're looking at the continuation. We got it. Fantastic. That's an entry pattern right there. Great entry pattern. So what I'm going to do is I'm going to look at taking a trade off the break of the structure. My stop loss is going to be up. Actually, to be fair, where it is at the moment, it's quite nice. And I'm going to have my target profit down a little bit lower. So let's have, yeah, stop loss is good where it is. I'm going to leave that there. And I'm going to have my target profit down here. Now, in this particular instance, when we're looking at this price action here, this is all looking great. We're definitely in a bear market. So what we're doing is the price action comes across and we have a price action pullback. It pull back further, and then what I'm going to do is I don't want to take a loss. I'm panicking big time now. I don't want to take a loss on this. Okay, I want to avoid that loss at all costs. So what I'm going to do is I'm going to move my stop loss. I'm going to move my stop loss past this point because there's no way the market's going to break through this area here. This area is a major level of resistance. I'm going to have my stop loss above there. That's fine. I'm still at a 1-to-1, so that's it. No way the market's going to bust through there. So we come up and we keep going and we keep going, and the market stops me out. Now, in this particular case, I wasn't very forgiving. There have been cases that I have seen where people have lost tens of thousands because they continue moving their stop each and every candle like this until they are running a 0.1-to-1 risk reward ratio at the end of it because they cannot bring themselves to realize the losses. Now when I talk about things like unrealized and realized is when you close the trade out and that becomes a realized loss or a realized gain. Unrealized is obviously the opposite. Unrealized is when the trade is still open. So if you have 10% profit, which is unrealized, that means you have 10% profit in open live positions, not closed positions, which means you haven't banked the profit yet or haven't taken the losses yet. Okay, so that there, perfect example of how loss aversion can affect you within the markets. So what can I do to avoid this?
Okay, so when it comes to trying to minimize the risk of loss aversion, I've got two major points of advice that you can go away with today. The first is the understanding that every single time you press the buy or the sell tab, you are spending that money. Now there is a big difference in the markets with spending money, because of course you're not getting a tangible product in return. It's not the same if you go down to Tesco's and you pick all your supermarket groceries and you pay for it, you get those groceries in return. Or if you go to a clothing store and you go and buy a winter coat, for example. You know, you go into the store, you pay the money because you're getting a return on your investment, you're getting your coat. So it's very different in the markets because there's never a guarantee that you are going to get a return on investment. You are spending money, but you're not sure if you're going to get anything in return. So we're not really built with that way inclined. We're always looking to give to receive because of the way our world works, because of the world economy, because of the way that our financial system is run. But you have to reinvent yourself. You have to recondition your thought process here. The way I see it, every single time I'm hitting that buy or that sell button in the markets, that is a sunk cost. I don't care about anything else. That's it. That money's gone. I do not expect a return. I don't expect anything from it. As soon as I spend that money in the financial markets, it is blown. Now, if I get a return on my investment, if my P&L rises as a result of that cost, then fantastic, that's great news. But if it doesn't, that's fine because I have zero expectation of that money coming back to me. So that's a really, really good way to think about it. Now, the next thing is about risk. Risk management and risk mitigation, massive factors when it comes to loss aversion. Usually people don't want to realize a loss and will move their stop losses and hold on to losing trading positions because they've usually risked too much in the markets. Do you know, it might interest you to know that I only risk a maximum of 0.25 to 0.5% per trade. That is my maximum risk exposure. I'm generally trading 0.25% increments, but because I'm constantly looking for a positive risk reward, 2 to 1, 3 to 1, 4 to 1, I am still seeing consistent monthly gains in the regions of 3 to 10%. So because of that fact, and that's exactly what I'm going to teach you in the coming videos, we have zero, let's say, risk factor to us in terms of our psychological imbalance that we've got too much money on the line. I risk 0.25% on a trade. I don't care if it hits stop loss. I don't care if 10 of them in a row hit stop loss. But I really would care if I was risking 5%, 10%, or even 20% of my account balances. It's about getting that risk in check so it doesn't knock your psychological balance out of whack. So those are the two main pieces of advice that I would give to counteract loss aversion. Proven, tested, my personal experience. Okay guys, so that's it for the loss aversion video. I hope you enjoyed it. Next up, we're going to be focusing our attentions on the hand of greed. Now, we're going to be learning about what the hand of greed is, how it adversely affects retail traders everywhere around the world, and most importantly, and as always, how to minimize the risk. So take care guys, and I'll see you in the next one.